I'm so excited for all of you to join us today. Thank you so much for taking time out of your day. And I am thrilled to introduce to you Pat Soldano and Russ Sullivan, who will share important insights collected from the Family Enterprise USA's Family Business Survey and provide valuable information such as their top tax and economic concerns, generational planning, and significant family business challenges. We will also learn how tax and economic legislation could affect you individually, your family office, and your enterprise. My pleasure to introduce Pat Soldano, who has spent over 30 years providing family office services as an owner of Simrit Family Office Services, and later as managing director of the Western region for GenSpring. Currently, Ms. Soldano is president of Family Enterprise USA, and its mission is to promote the growth of generational-owned family businesses in the United States. And she's also president of Policy and Taxation Group, which she formed in 1995. This works on tax and economic policies for successful families, family offices, and family businesses. It is also my pleasure to introduce Russ Sullivan, who is joining Pat today as chair of the National Tax Policy Group at Lobbying and Brownstein, providing unparalleled insight into the legislative and regulatory risks and opportunities related to tax policy. Russ is a Capitol Hill veteran who spent 14 years with the Senate Finance Committee, including 9 as staff director. He leverages his vast network and industry expertise to devise and execute complex strategies for both nonprofit and for-profit clients on a broad range of issues, including healthcare, pension planning, trade, economic development, and tax policy. It is my honor to have both of you join us today to present all of your data and your insights. And with no further ado, I turn the program over to the two of you. Thank you so much.
Well, thank you, Cynthia. We really appreciate this opportunity to be on the call with everyone today. So I think you've already discussed our backgrounds. You've discussed the organizations that I run today. And Policy and Taxation Group, as you said, I formed in 1995. It works exclusively on tax and economic issues that affect family offices and successful individuals in this country. And then FEUSA, or Family Enterprise USA's mission is very simple. It advocates and promotes generationally owned family businesses and their lifetimes of savings at a national level in Washington, D.C. It is a 501c3 organization. So today I'm going to start by talking to you a little bit about those results of Family Enterprise USA's annual survey. It is something we've been doing since 2007. We're very excited about the growth of this survey and the results. So family businesses in this country are important. We have learned that. There are 32 million of them in this country. There's 87% of the businesses in America are family-owned businesses. That's why they're important. That's why members of Congress should listen to them. 59% of the workforce in this country, or 83 million jobs, and 54% of the GDP, or $7.7 trillion. That's why family businesses are important. That's why members of Congress need to listen to them. In our survey this year, we had 789 respondents, 25% greater than last year, and we covered 40 states. We're very proud of those results. We're very proud to have EY as our Platinum Plus sponsor for this survey and for the work that we do in Washington, D.C. These are some of the groups that support the work and sent the survey out for us. We couldn't do it with these family business centers around the country, over 40 of them who sent the survey around, as well as PKF O'Connor's Davies. We really appreciate them sending it. And for those that you took the survey, thank you so much. We also have 5 trade associations that we work with that you can see at the bottom of the screen: the American Trucking Association, Energy Marketers of America, American Air Conditioning Contractors, AED, Associated Equipment Distributors, and National Funeral Directors that are very important to our efforts. So let's start by talking about the family business overview. So 78% of the family businesses that we interviewed are a pass-through entity. And the reason that that's important for us to know is because there is legislation that Russ is going to talk about around pass-through entities. And we had no idea how many of you are pass-through entities. So you operate as an S Corp or an LLC or an LP. And many of you know that 199A legislation has helped you, and that may be potentially going away. So we can go to members of Congress now and say 78% of the family businesses in America operate as a pass-through entity. 75% of you have trusts. Again, a statistic we did not know until we did this survey, and we have learned that since 75% of you have trust, it's something that members of Congress are now listening to. And when they think about eliminating grantor trust, which has been proposed, they now understand the impact it's going to have on you. In terms of the survey and the industries, 22% are from manufacturing. You can see 11% from construction, 7% from retail, and only 4% from agriculture. So while family farms in this country are important and always will be, the members of Congress need to understand that manufacturers and construction and retail has the same illiquid nature of their assets. So if we're going to be helping out family farmers, we need to make sure we also include manufacturers, those other industries that have the same issues and the characteristics that family farms have. Gross revenues, 25% have over 50 million in revenue. But if you look at the red typing, those percents, if you added them up, we have over 15% that in fact have over 100 million in revenue. So this survey is conducted not only with small businesses, but medium-sized businesses and large businesses as well. So somehow I've lost my way here. Sorry about that. Let's get to where we need to be. 81% of you have been in business over 20 years. And in fact, 32% have been in business 50 to 100 years. How many public companies can say that? So we understand that family businesses plan their business as a legacy. They plan it not only for their families' generations to come, but also for their employees' generations to come and to support their community. And to that point, 70% of them have generations of employees working in the business. So think about that. Mother, daughter, sister, brother, all of them are working in the business side by side. I apologize for the slides moving. I promise I'm not doing anything. So 46% of you pay your employees better in terms of wages and benefits. Again, you really understand the importance of your employees and you pay them in benefits and wages better than non-family businesses. 50% of you contribute to local charities. And last year, this number was 70%. That's an important statistic because if the family has to be sold to pay the estate tax or some other reason, the family loses their livelihood. But the community also loses all of that local giving. 24% of you operate in more than one state. And that's an important statistic because while you're all US based, you operate in multiple states. And in fact, 34% operate in more than one state. 67% have a family office. First time we've asked this question. And in fact, 79% are single family office, which is not a surprise to me. I think that's true of most family businesses. If you have an office, family office, it could be embedded in the family business itself, or it could be separate. And if you have a family office, 57% are operating as an administration, accounting function, more so than other functions, but it can include all of these functions. So quickly, I'm going to talk about the policy overview, but Cynthia, I'll ask you first, do we have any questions so far to date? And I'm going to take that as a no.
Not yet.
Okay, thank you, Cynthia.
Thank you.
Tax policy, the top 3 tax policies this year. Income tax, once again high, but note it's lower than last year. Estate tax, again, also in second place, but lower than last year because 5% are worried about a wealth tax. And so are we worried about a wealth tax. It would be just very destructive to family businesses. Wealth tax wasn't even on our radar last year. So it is a concern. There are proposals advocating for a wealth tax. And Russ may talk a little bit about that. Lastly, in the survey, we asked, if you had more money because you paid less in taxes, what would you do with that money? And because members of Congress believe that most of you would just pay yourself more in distributions. And we found that isn't the case. 52% of you will invest more in the business, and 30% will pay your employees better, and only 8%, in fact, will make distributions to yourselves.
Pat, would you do a favor and just clarify? We have a question on what is a family office, and that's actually a good question. It may be a little confusing to many listeners. So would you mind just taking a moment to clarify what a family office is?
Sure. It is difficult to define. I've just had about 20 different emails this morning from a group of individuals asking that very question. It is hard to define. A family office is typically an organization, or it could be a group of professionals in as example, a family business that manages all of the personal financial affairs of the family itself. So typically a family office is formed either formally or informally when the family reaches a level of liquidity in which they need separate management around that liquidity. And maybe, again, separate professionals. It may be somebody working in the family business that says, okay, I guess I need to learn about investments, and now I got to do the family's tax return. Now I've got to do some family meetings and some family reporting, because the wealth of the family has grown to a certain level where it becomes a business in of itself. That's a very broad definition. There are single family offices that are full service and comprehensive, meaning soup to nuts. They do everything for the family. And then there are family offices that just do administration or just do investments, or could just be managing the private foundation. So it's a difficult, long answer. I'm sorry for that, but it's a difficult question to ask.
That was a very good answer, Pat. Thank you.
You're very welcome.
Thank you.
So moving on to the economic policy, the top economic policy this year, in 2023, was reducing the income tax. We believe that's the case because, as I already shared with you, 70% of family businesses operate as a pass-through. They're paying 37% in taxes, and corporations pay only 21% in taxes. But this year, look at the difference. This year, reducing the federal deficit at the top of the list, and then income taxes, and then reducing the estate tax, and then government regulation. So the difficulty here is, I believe, that family businesses are very concerned about the national debt. They understand what debt does to a company. They certainly understand what it does to a country. And so they are concerned enough that they would rate it number one in terms of their economic policy concerns. So I'm finished with the survey results. I'm going to talk quickly about the Congressional Family Business Caucus before I turn it over to Russ. But I would just ask if there are any questions about the survey or some of the results that I delivered today before I do that. Okay, I'm going to take that as a no. Since Cynthia, oh, there you are, Cynthia.
Thank you. No other questions. Thank you.
Okay. So the Congressional Family Business Caucus is something very important. We helped Congress to form over about 18 months ago. It is a bipartisan caucus. That's very important. That's how we run as a government. That's how we should continue to run. It is an education caucus. It's not a policy caucus. We wanted to make sure we kept it bipartisan, and we felt that if it was a policy caucus, that may not happen. So it's an education caucus. Its purpose is really to educate members of Congress around what a family business is, because we've learned they really don't know. When I say family business, they usually say small business, and I correct them and make sure they understand they're small, medium, and large. And they usually say, oh, well, you mean a family farm? And I said, no, there's a lot of family businesses out there. And as I shared those statistics with you earlier, that are not family farms. They're in a lot of other industries. So really, when we realized how much they don't understand about family businesses, we encouraged them to form this Congressional Caucus. We have helped them bring on members. We have funded the events for them. We have organized the events for them. It is their caucus, but we do all the heavy lifting. And currently, these are our co-chairs. Very excited to have bipartisan co-chairs in the House, as you can see on the screen. We've started in the Senate. We have a Republican. We're working on a Democrat in the Senate. And currently, we have 42 members of Congress that are members of this Congressional Family Business Caucus. About 40% of them are Democrats. We try to keep this in an equal Republican-Democrat manner so that it stays bipartisan. We have addressed who is likely to be on this caucus by researching all those members of Congress, and there are over 100 of them that come from a family business. So we're very excited about it. Our next caucus meeting is actually May 14th in Washington, D.C. If any of you on this call are from a family business and you're a member and you'd like to come, we'd love to have you there. So please let us know and we'll send you all the details. So with that, unless there are questions, I'm going to turn it over to Russ Sullivan, and he's going to talk to us about the election and tax policy changes that are possible and that can be influenced by the elections.
Great. Thank you, Pat. And thank you, Cynthia. It's an honor to be with all of you today. And I'm going to lead a discussion that's going to explain to you what's going to happen with regard to your tax bill over the next, say, year and a half. Will Congress really be changing the tax law? Am I or my business, are we going to have a different result a year, 2 years from now? And the answer is, I'm here because the answer is yes. I'm coming to you today from Washington, D.C. And the Brownstein Law Firm, and we're going to talk about several things. First, we're going to talk about the election and how those results will dictate policy changes in the tax space. We'll actually peer ahead, and I'll give you a glimpse of what's going to happen with respect to legislation after the election and a new Congress takes their seats in January 2025. And then we'll talk a little bit about which party wins, what will happen. We'll talk about a Trump victory, and we'll talk about a Biden victory, and go through some of those. So if we could go to the next slide, we'll start with the presidential election. I don't need to tell you this. We're going to have a fierce and very close presidential election. The polls say so, and history tells us so. If we could go to the next slide, I'll explain to you why. You all come from all over the country on this webinar today. And if you're in one of the green states highlighted on this slide, your vote will actually count a little more than everyone else's. These are the 7 states that are likely to decide who the next president is. And you may say, well, wait a minute. I'm from a gray state. You're saying my vote doesn't count? Well, no, your vote counts. It's just that we really already know who's going to win your state. So California is going to be won by Joe Biden, but Texas is going to be won by Donald Trump. But there are 7 states that are going to be very close. They were very close the last time, and the polls thus far are very close. Now, of these 7 states, North Carolina went to Trump, but the other 6 went to Biden, and that's why he won the election. This time, however, I think most people expect that it is doubtful that Trump or Biden will win all these states. And so whoever wins the most of these states with the electoral votes that go with them is likely to be our next president. If Joe Biden wins Wisconsin and Michigan and Pennsylvania again, he will get another term as president. But if Trump breaks through in one of those, it is likely that Trump will also win North Carolina, Georgia, and Arizona, and perhaps Nevada. And then he could be the next president. So that's what we know about the presidential race. Now we go to the Senate, where we actually know a little more. It is very likely that Republicans will take control of the Senate beginning in 2025. Now, if Joe Biden wins the national vote by 8 percentage points, maybe not. But if we have a very close race, if we have a 50-50, a 49-49, a 50-49 race between Biden and Trump, then in the Senate, there is likely to be controlled by the Republicans. Right now, it's controlled by Democrats who have 51 seats. But as you can see, there are 3 red states here, Montana, Ohio, and West Virginia, that could very well switch to Republican. West Virginia, in fact, we're pretty sure it's going to switch to Republican. The sitting governor in West Virginia is running for the seat that Joe Manchin, a Democrat, is vacating, and we're not really sure who the Democrat is that's going to run. So in Ohio and Montana, it'll be closer. We have 2 incumbent senators, Sherrod Brown in Ohio, John Tester in Montana. They are running again, but Donald Trump is going to win both of those states, and he will carry with him a lot of votes to the Republican nominees in those states. In addition to that, there are several states, there are 3 states that have sitting Democratic senators, but the Republican looks very strong this time around, and so you could even see some of those states flip and become red. So the Republicans could have as many as 55 seats in the Senate. More likely, they'll have less than that, but they're likely to take control. With regard to the House of Representatives, the opposite is true. Right now, there's a very close margin in the House of Representatives. The Republicans control, but only by a couple of votes, and there are a few vacancies as well. But there are a number of Republicans who won in 2022, and now after redistricting, a majority of the voters in their district actually voted for Biden instead of Trump back in 2020. And so if Biden's able to maintain those votes and it carries down to the individual running for the congressional seat, we certainly could have enough votes flip and switch that Democrats control the House. All right, when will we know what's happening? Well, here's a chart that you may have studied in 9th grade civics, but I'll remind you, we have Election Day in November, the first Tuesday, but it's really not until January 20th when the new president and vice president are inaugurated. In between there, we have a lot of action by the states. The governor of each state appoints electors. They get together. Someone is designated in the state, usually the Secretary of State, to certify who won. They tell the electors. They certify the electors. Those electors then send their votes to Congress, and then Congress counts them. I think this year we'll probably have some more confusion. If we have as close a race as we did last time, I think there are now more attorney generals who will sue between November 5th and January 20th about the accuracy of the election results. We may have some secretaries of states or governors that say, wait, we're not going to send our electors to D.C. yet because we're not sure who won our state. So be prepared for that. You probably won't know on election night who won, but eventually the courts will work this out the way they have in previous times. Now, let's move to the tax issues. And you can go to the next slide. We're going to have a big tax battle in 2025. And let me briefly explain to you why. Every first year of a president's 4-year term, they generally get a tax bill to pass the Congress. What happens is the candidates for president put out an economic plan, a plan that will increase economic growth, expand jobs and wages. And most of those provisions usually are tax provisions, tax incentives. They may be targeted toward certain industry or they may be broad-based. But going back to Ronald Reagan, virtually every president has gotten to do this. Now, it is true that most of these presidents had a majority in both houses during their first year of office. But regardless, that is likely to be the case again. There's a second reason that we are likely to see legislation in 25. And that is the last big bill, the Tax Cut and Jobs Act, which Republicans passed in 2017, The corporate provisions are permanent, but the individual and pass-through provisions are temporary. This is what Pat referred to earlier. All of those provisions will expire at the end of 2025 unless Congress acts. Congress doesn't have to do anything. If they argue with one another and fail to reach consensus, can't pass a bill, or can't resolve a bill between the two chambers, then at the end of 2025, individual tax rates will go up for every bracket. We will have itemized deductions. All of them will be restored, but the standard deduction will drop by $10,000 or so. There won't be any SALT limitation. So if you're from a state with substantial state and local income taxes, that might help you a little bit. But then there are other things like the child tax credit that goes down by $1,000. And for those of you who are doing estate tax planning, the estate tax exemption would revert from its current level around 13 plus million back to around 7 million. In addition, on the pass-through side, there's a 20% deduction for pass-through entities that effectively reduces the top tax rate for pass-through businesses from 37% down to 30%. But that deduction will expire at the end of 2025. So how do they decide what they're going to do? Well, let me tell you generally what happens. The two parties tend to work on what they're going to do after they take office the year before they take office. So right now in 2024, both sides are working hard to try to develop a plan to pass economic legislation, including tax legislation, early in 2025. Here's what happens if Republicans sweep. And let's say Trump wins, they take control, retain control of the House, and they take control of the Senate. Now, Mitch McConnell, who's featured here, won't be the leader then. It'll be John Thune of South Dakota or John Cornyn of Texas. But what Republicans likely would do would probably be make permanent or at least extend for another 8 years or so all of the individual and pass-through provisions. They're likely to try to extend the deduction for pass-through businesses that I just mentioned. They're likely to extend the $13 million state tax exemption. We hope that they will reduce the rate from 40% down to 20% for the estate tax. We're working on that. But they will, in general, at least try to maintain the law that they passed back in 2017 and has been in effect for 8 years. They will try to eliminate some of what the Democrats passed recently. In 2022, Democrats passed what's called the Inflation Reduction Act that included a lot of incentives for green energy projects, electric vehicles and such, as well as it had some other changes. Republicans would like to repeal some of that, and they may very well repeal the electric vehicles tax credit of $7,500. They're going to do some other things. You can see they really want to scale back the IRS enforcement money the Democrats added to our tax collection agency. And also, Republicans are not averse to raising taxes. They're really looking at some of the Ivy League schools with large endowments. They passed an endowment tax in 2017. They may very well expand that. So what are their challenges that Republicans face? We go to the next slide, we'll see that number one, we're not 100% sure that Trump is committed to extending this pass-through deduction, which we've described. It was not in the Trump plan during his campaign in 2016. It was added in the United States Senate just before the bill went for its final passage in 2017. And Trump has not been very vocal about this. We expect that Republicans on the Hill will persuade him and they'll join to extend the provision, but there's a little bit of a doubt. In addition, we don't know if Trump will actually come out with some new proposals in the campaign, whether he'll want to do something. There's been some indication he may want to lower the corporate tax rate. But Republicans have a big challenge in that they've got to decide whether they're going to pay for the legislation that extends these tax provisions. And there's a group of Republicans who say, well, we really shouldn't have to pay for extending current policy. We're just keeping it as it is. But there's an increasing number of Republicans who are concerned about our federal deficit and the cumulative debt. And they've said on recent pieces of legislation, we really should pay for whatever we're doing. We should pay for it either with revenue increases or more likely with spending cuts. So you can see some of the provisions, if Republicans extend them, actually will raise money. So extending the SALT cap of currently at $10,000 actually would raise about $1 trillion over the next 10 years, allowing them to extend some of the tax cuts that were in that legislation. Now, let's move on to the Democrats. What if they sweep? Well, they have a very different set of priorities. They would increase the child tax credit. This has been probably the top priority for Democrats for the last few years. They'd like to, it's $2,000 currently. They had it increased above that amount for a period of time during the pandemic, but that was a temporary provision. They would like to increase it to say $2,500 or so and allow more taxpayers to claim the credit. Democrats want to remove the SALT cap. More of the states that have senators and representatives from them are relatively high tax states from a state level. And so Democrats would like to remove that SALT cap totally, or at least raise it. Democrats are very fond of raising taxes on corporations. They would easily raise the corporate rate of 21% to at least 25%. President Biden has proposed 28%. So we could, if we have a Democratic sweep, see that rate go up. Democrats will defend the energy tax credits in the Inflation Reduction Act, but they would allow the top bracket income tax rates to expire. So in other words, that 37% rate, they would let it expire, go back to 39.6, and the 35% rate, they would clip it for some categories and allow that to go to 39.6 as well. More recently, Democrats have focused on a new proposal, and this one is somewhat problematic to family-owned businesses. They have proposed in the Senate a regime that would mark-to-market assets on successful entrepreneurs each year. As you know, income is generally taxed when you recognize it. If you receive the cash, if you sell the stock, if you sell the property, if you trade it, those kind of things generate the tax on the appreciation in the property or the earnings on it, or you can take a loss if you've lost money. But Democrats would like to impose a mark-to-market regime annually on individuals. And so they've come out with a proposal. If you go to the next slide, Ron Wyden from Oregon, who chairs the Senate Finance Committee, introduced what he calls the billionaire's income tax. And he says we ought to treat wealth like wages. So we ought to tax wealth annually, periodically, and not wait till the assets are sold. He's troubled by what he thinks is a strategy that a lot of people employ to buy, borrow, and die, or to build assets, a business, borrow against the business, and then when you die, pass it tax-free to your family or whoever you choose to inherit the property. But if you look at some of the details, it doesn't just apply to billionaires. It applies if you have $1 billion or if you have $100 million in income. But it is even more applicable than that. In the trust context, all you have to have is $10 million in income and you're subject to the regime. So this would be a significant diversion from the historical approach of taxing individuals as well as businesses when they actually recognize their income. I don't expect that this bill is going to pass anytime soon. It certainly won't pass in 2024, and even 2025, it'll be tough because there are some Democrats who are very skeptical of this. but it has been gathering increasing support among Democrats at a rapid clip. There are 18 Senate Democrats who introduced this bill along with Senator Wyden. In addition, this is just one of several wealth tax ideas that have been proposed by Democrats. Some of them just want to tax the value of your assets, the net value, valuation, net of your liabilities. And they want to impose a tax at 2% or 5%, some percentage annually. All right, so let's go to the next slide. President Biden has made clear kind of what he wants to do. He put out his budget and he's made his goals fairly clear. I'm sorry that these letters are written backwards. For some of you, I'm not sure you can read them, but in any event, he's proposed $2 trillion in tax increases on individuals earning more than $400,000 per year. Now he's got another set of $3 trillion increases on corporations, but in this context, he mostly increases the individual rates. It's got some estate and gift tax increases, and then a few other items. And to give you a feel for it, Democrats have held a number of hearings. They focused on grantor trusts and reducing individuals' ability to use those. They've focused on private placement life insurance, and they've also focused on this issue of unrealized gains. So what would happen if Democrats sweep Congress? Well, we're going to have kind of a repeat of what happened in 2021 and 2022. And let me compliment Pat Soldano, who led a broad coalition of organizations who were opposed to many of the tax increases that Joe Biden proposed during the campaign and tried to get enacted when he was first elected. And these include a set of estate tax provisions. You can see all the ones here that were proposed, including the elimination of step up in basis, a dramatic increase in the taxation of the estate tax rate, as well as imposing capital gains tax on assets at the point of death. All of these were removed with the help of members from both the Senate and the House of Representatives. The next slide shows you some of the rate increases that we had to fight. There was an increase in the income tax rates, as we talked about, capital gains. There was also even a surtax proposed on people earning above 10 million and 25 million. Although note that the trigger amount for a trust was much, much lower, as low as $200,000. So fortunately, Kyrsten Sinema, pictured here in the elevator with Joe Manchin, along with his help, really scuttled most of these increases and said she wouldn't vote for the bill if they included these tax increases. Finally, there were a few other provisions from the Inflation Reduction Act applying to a wide variety of situations. There was a net investment income tax. There was a limitation on putting private stock in IRAs and allowing it to grow there, required divestment, taxation of carried interest, elimination of the like-kind exchange treatment. And all of those, fortunately, were removed as well. We would expect to have battles on all of those issues again if Democrats sweep. And that's why we need your help. We need your engagement to get ready to do that. Finally, the third option is that we have a divided government. In other words, we might have President Trump win, but Democrats control the House and Senate. We could have Biden get a second term, but Republicans control either the House or the Senate or both. In that context, we are likely to see a little bit more of a drawn-out battle. They will probably take them most of 2025 to decide what they can agree on. But let me give you a little insight as to what is likely to be agreed on. First of all, they will extend most of the middle-class tax cuts from TCJA. Democrats have railed against the TCJA, saying it exclusively or almost exclusively advantage the wealthy and big corporations. That's not really true, but they've said that. as we get closer and the tax increases are about to take effect, I predict the Democrats will do exactly what President Obama did in 2010. He and Democrats had complained about the George Bush tax cuts, but when they were about to expire, they changed their minds. They supported almost all of the tax cuts from that previous 2001 legislation. I think the same will occur here in 2025. However, I think both parties are for reducing incentives for foreign derived income. In other words, both parties want companies to move their operations to the U.S., both their research, their manufacturing operation. They're not sure they really want to subsidize to the tax code the operations that those companies do overseas. They may reduce incentives for foreign investment in the U.S., especially from China, where they've had a series of hearings on that lane. Then finally, both sides are open to revenue raisers. I talked about higher education, endowments earlier, and I think there's some of those that they can find some common ground on. So that's what we expect to happen in Congress in 2025. And again, I will pause here. I'll invite Cynthia to rejoin us. And if we've had some questions or comments from the participants that we want to discuss, or Pat, if you have some other questions you want me to address, happy to do so.
While we're waiting for Cynthia, I have a question for you that I think would be interesting to our listeners. And that is, you addressed, the possibilities of a divided government and the likelihood of a divided government, and the House maybe being Republican being a Democrat, and the Senate maybe being Republican, and who knows where we're going to be in the White House. And you've addressed the timeline. So with the 2025 bill expiring, the TCAJ expiring in 2025, if we have a divided government, how quickly do you think things will actually be focused on? And then, and the second part of that is, how quickly do you think we'll see any resolution to those expirations?
That's a great question. I think there are different timelines. So if either party sweeps and has full control of the House, Senate, and the White House, then I expect them to move quickly. What they'll do is they'll pass a budget real quickly, agree on it, and then they'll try to pass the tax legislation in the first half of 2025. But if, as you outlined, Pat, there's divided government, then they're not going to be able to pass a budget very easily. In fact, they're unlikely to pass a budget. Therefore, there are a lot more rules that they have to follow in order to bring significant legislation to the floor. They'll have rules about it being paid for. They'll have a higher threshold of votes they have to secure in the Senate, have to be 60 votes rather than 51 votes. All those things mean that it will take a while for both sides to determine what their priorities are, determine what they can accept that are the other party's priorities, and to sit down at a table and actually work it out. We've seen recently how it took months and months to resolve what we're going to do about the war in Ukraine, the attacks in Israel, and assisting Taiwan. But they finally did it on a bipartisan basis. I think that will happen in 2025, but I think it'll be late in the year, November or December, before they really reach an agreement on a tax package.
Question for the two of you. Is it safe to assume that Democrats are low and middle income inspired and Republicans are business and wealthy inspired?
Well, that's a great question. There's no doubt that the Democrats are focused on middle income and really lower middle income. They're more concerned. The child credit proposals, the other proposals for low income housing, tax credits and all indicate that their biggest focus is on lower middle income individuals and low income individuals. They also support middle class. The Republicans have changed though. They're beginning to change. Most thought that they were historically middle class and supporting successful entrepreneurs, as I call them. who make more than $400,000. But the Republicans have had a number of new members join both the House and the Senate who are not really supportive of big corporations the way the Republican Party previously had been. And in fact, the new chair of the Ways and Means Committee, Republican Jason Smith, he says his priorities are families, farms, and small business. And he is not really spending a lot of energy trying to promote policies that help big businesses. He's focused it on the main street, small businesses, families, and agriculture. So now that he's not speaking for all Republicans, but we certainly see an increase in the number of Republicans that are focusing more on the middle class and small business.
And
do you concur?
I do. And I would say that I think there's kind of a misinformation or misnomer about TCJA because most people think it only benefited the wealthy or successful entrepreneurs in this country. And the fact is there was many provisions in TCJA that supported the middle class. And if this thing does expire and all these provisions expire, they will be harmed, including things like the income tax rate, capital gains tax rates, and other things. And we didn't talk about it today, but there are 3 provisions that really affect family businesses, as you know, Russ, better than I do, that are in the current tax bill that went on to the Senate that's going nowhere. And that is, bonus depreciation being restored, R&D expensing being restored, and interest deductions being restored, which has bipartisan support, and disappointing that we can't even get that through our Congress. So we're hoping that that will be revisited later in the year or certainly in next year.
And if the Democrats win and they make all of the changes, for what tax year will the tax cuts be instituted?
That's a great question, Cynthia. The answer is it depends on when the bill is passed. If they pass a bill early enough in 2025, they will be tempted to try to apply some of those provisions for 2025. But my guess is that most of the provisions affecting an annual calculation of income are more likely to be effective beginning January 2026. But if they make changes in capital gains rates, for example, then they will make the provision effective the day the bill is passed or signed into law, because they don't want people that have time to change their plan and accelerate some transactions before the higher rate takes effect. So it might be a hybrid between date of enactment and the following year. If it takes them 9 months to pass the bill and it's September of 2025, no, they're not going to make it retroactive to January 2025. They will definitely make it effective for the following year, 2026.
And I would add that it is rare, and Russ obviously worked the Hill for many years, so he knows better than I do. It's rare that they actually pass a bill and make it retroactive. It has happened, but it's rare. So it's usually date of enactment, which is better. So people really can do some planning and not have to worry about doing planning that's going to get undone.
I will agree with you, Pat, except that's true for tax increases. If it's a tax cut, they will likely want to make it retroactive to the beginning of the year. So, for example, let's say that they don't pass legislation by December 31st, 2025, and so we're into January 2026 or February, and Congress finally acts then I'm pretty sure they would make their tax cuts retroactive to January 2026 so that there's not a gap there of a short period that had a higher tax rate.
Yeah, I agree.
And just curious, I had a question. These have been posed by the audience. But what would be the biggest takeaways from what you've presented for private business owners, regardless of election results, or what can they do to be proactive versus reactive given what may lay ahead?
Well, let me answer that first, because this is my passion. They need to be advocates. This is why I do this. Their voices need to be heard. It's so, so important. And they always say, well, maybe tomorrow, or let somebody else do it. Laws are going to happen in this country. Legislation is going to happen. And so if you're not part of the discussion, you're not going to like the conclusion. I just really think that strongly, whether it's family business or whatever else is important to you. And we have learned, as I said earlier, that family businesses are so misunderstood in DC that your voice needs to be there. Come to the caucus meetings, call your member of Congress, email them, go to town hall meetings, go to fundraisers, talk to them. It doesn't take much. And really, it's a simple, tell them what your challenges are that you face every day. There is absolutely nothing better. And what we've learned from our family business owners is once they come and they realize how important it is, the job that they're doing, and we not only have the caucus meeting, we schedule them all for Hill visits. And most of the time they come back because they're so inspired when they do these Hill visits, because they realize that members of Congress and staff really do want to hear from them. I mean, you're the voters. And so I can't encourage people enough to do it either in their districts or to do it in Washington, D.C., because they really don't understand family business. And if they don't hear from their voters, they're gonna learn from organizations that may not understand the realities of what you're dealing with every day.
And so yes, go ahead.
Let me add to that briefly, if I may. I'll be a little more specific. People should call your accountant, and I'm sure the people at O'Connor Davies would be happy to help you, and figure it out. Okay, what if TCJA expires? How would that affect our family business? Are our tax rates going up? Our tax liability going up? Or would it stay even? The answer is it's going to go up. And they can tell you by how much, and then you can decide how important an issue this is to you. Particularly ask, what if the pass-through deduction went away, the 20% deduction? How much would that affect my business? And then, and if you're organized as a corporation, how much more would I have to pay if the rate went up from 21 to 25%? And then you can take that information and find your member of Congress. You should not be ashamed if you don't know who your member of Congress is. To be honest, they just redrew all the lines all across the country. So unless you're from a state that only has one representative like Wyoming, your member of Congress may have changed. So look it up, find out who your member is. They'll be your member for the next 10 years. And then look them up and give them a call. Try to meet them somewhere. Go to an event where they're speaking. And as Pat said, share with them your information. Tell them you want to be a resource and give them your opinion.
How does a family business caucus have a way that voters can recommend to their Congress their ideas?
Sure. So there are many ways. You can call that member of the caucus's office, and you can talk to one of their staffers. You can call the people that live in your district or in your state, if you're calling your senator, and you can talk to them back in your home district. They'll have someone assigned to listen to your reviews and pass them along to the members in Washington, D.C. You can write them. You can email them. They'll respond back to you. Or if you're interested, you can certainly work with us. We're helping members who join the Family Business Caucus to establish sort of kitchen cabinets or councils of family-owned businesses that live in their district, who are important people in the communities that they serve. And these members want to know who you are. They want to be able to call you when an issue comes up and say, what do you think? And so that's another way you can do it.
And so would it just be notifying those people? I have a gentleman from New Jersey who would like Mike Sherrill and Cory Booker to join. How would he do that?
That's right. He can call the offices of Mikey Sherrill and Cory Booker and say, please join this caucus, and he'll get a response. If Cynthia, if they want to give you the information, we'll send you some information to send to your member of Congress about the Family Business Caucus. Pat, I don't know. I guess we've eliminated our slides, but we had it up at the end. But we can get to you some information about the caucus, so that you send the information to them and get them focused on the right issue.
It's a simple ask. It's just join the caucus. It's bipartisan. It's educational. It's pretty hard, even though members of Congress do say no. Usually it's because they have too much on their plate. It's pretty hard for them to say no. Most of them just don't answer. So it takes many, many, many touch points. And so Russ is absolutely right. You really have to reach out to your member and follow up with them and really, insist that they join this caucus, especially if they're a family business owner.
But when members have joined our caucus, Pat, it's because one of their constituents who votes has contacted them.
Exactly.
It's good to know. Good to know. And this is an off question somewhat, but what percentage of Senate staff actually do their own taxes?
That's a great question. I was a Senate staffer for 18 years, and we did some clinics in the Senate and tried to help people do their own taxes. We usually had about 2 senators who prepared their own taxes because they really wanted to know how it worked. At the staff level, you have a higher percentage who do their own taxes because their taxes are fairly simple. They may there's a lot of young people fresh out of college. So from when I was on the Hill, there were probably 25% of the staff did their own taxes. That may have gone down a little bit now since in the last few years, but there's a majority of them do have them done by some firm.
Okay, great. And given everything that you've covered, what should be the biggest takeaways for private business owners?
Well, for me, it would be what I continue to say, which is, we are your voice. Family Enterprise USA is the voice for family businesses at a national level in Washington, D.C. Many of you work with trade associations. We work very closely with them. They're very important to your industry. But we work on those issues that affect the families of those businesses, like income tax, since 80% of family businesses operate as a pass-through. So let us be your voice. We are a 501c3 not-for-profit charitable organization. Most people are surprised at that. We are allowed to advocate for you and all your challenges that you face. So I would say, tell us your story. We do videos on YouTube. We have a YouTube channel. We have 25 different family business videos. Again, sending it out on social media to members of Congress, just trying to get them to understand the importance of the families of those family businesses. And that is how we're unique. But the trade associations work with us because they need the information that we have to help their family business owners. And as we've learned with everyone from the American Trucking Association that has approximately 65% of their members are family businesses to the National Funeral Directors Association has 99% are family businesses. It's very, very important that someone's there fighting for those family businesses. So let us help you.
And if you want to go the extra mile, come up to one of our fly-in days in Washington, D.C. We'll introduce you to your senator or your representative. We'll go with you to the meeting, and we'll allow you to tell your story to them.
That's wonderful. Absolutely wonderful. I can't thank you enough for all of this information. I'm sure it's fresh for many and new, and the efforts that you both put in to changing the lives of family business owners and businesses is incredible, and really appreciate your time, your preparation for all of this. It's been an honor to host you two. Thank you so very much.
It's been our pleasure. Thank you, Cynthia. We really appreciate the opportunity.
Thank you.
Everyone have a great day.
You too.